Welcome back to Capitura. Today, we are going to dismantle the single most expensive lie you have ever been told. The lie is that you are rational. The lie is that when you look at a price chart, read a balance sheet, or decide to buy a house, you're acting like a calculator, cold, logical, and optimized for your own best interest. Standard economic theory, the dogma that has ruled global finance for a century, assumes that every market participant is a rational agent, someone who always maximizes utility and never leaves money on the table. But look at your portfolio. Look at your transaction history. Look at the dusty exercise bike in the corner or the subscription services you forgot to cancel. You are not a calculator. You are a messy, emotional, impulsive, and contradictory human being. And in the financial markets of 2025, that humanity is being harvested by algorithms that know your flaws better than you do. The book we are dissecting today is Misbehaving by Richard Thaler. Thaler is not just an economist. He is the rebel who broke economics. He is a Nobel Prize winner who proved that Homo economicus, the rational man, is a myth. He showed that we are actually Homo sapiens, predictably irrational, prone to miscalculation, and vulnerable to psychological traps. This book is your shield against your own brain. In an era of gamified trading apps, one-click checkout, and algorithmic manipulation, Thaler's work is the only thing standing between your wealth and your instincts. To understand the magnitude of Thaler's contribution, we must first understand the enemy, the econ. Thaler uses the term econs to describe the imaginary people that traditional economic models are based on. An econ is as smart as Einstein, has a memory of an IBM supercomputer, and the willpower of Gandhi. An econ never buys high and sells low. An econ never holds onto a losing stock just because they don't want to admit they were wrong. An econ never eats too much or saves too little. For decades, Wall Street built its models assuming you were an econ. This is the foundation of the efficient market hypothesis, the idea that asset prices are always right, because rational actors instantly correct any errors. Thaler looked at this and said, "This is nonsense." He introduced the human into the equation. Humans have limited processing power. They care about fairness, they are lazy, and they hate losing money more than they like making it. So, why does this distinction between econs and humans matter today? Because in the modern digital economy, the econs actually exist now, but they aren't people. They are the high-frequency trading, HFT algorithms, and the AI-driven market makers. They are as smart as Einstein and have the willpower of a machine. You, the retail trader or investor, are the human entering an arena filled with econs. When you trade crypto on a centralized exchange or buy options on Robinhood, you are a human playing chess against a supercomputer. The algorithms are programmed to exploit the specific behavioral biases that Thaler identified. They know you will panic sell when the chart paints a red candle. They know you will FOMO, fear of missing out, buy when the green candle stretches. Understanding misbehaving is no longer an academic exercise. It is a survival guide for a biological entity trying to survive in a silicon marketplace. We begin our descent into the human mind with one of Thaler's most famous discoveries, the endowment effect. Thaler noticed something peculiar in his early experiments. If he gave a student a coffee mug worth $5, the student would refuse to sell it for anything less than $10. However, if he asked a student who didn't have a mug how much they would pay for one, they would only offer $2 or $3. Rationally, the mug is worth the same amount to everyone. But psychologically, once you own the object, its value doubles in your mind. Giving it up feels like a loss, and humans hate losses. This is the endowment effect. We overvalue what we already possess simply because it is ours. We attach our identity to our possessions. In a landscape of 2024 and 2025, the endowment effect has been weaponized by the digital asset industry, specifically in the realm of NFTs, non-fungible tokens, and community cryptocurrencies. Consider the phenomenon of diamond hands. This is essentially the endowment effect rebranded as a virtue. You buy a digital image of a rock or a monkey or a meme coin with zero utility. Theoretically, you bought it to make money. But once it is in your wallet, you become attached. The community tells you that selling is weak. You start to value that asset far above the market price. Even as the price crashes, you refuse to sell because it's worth more than that. You are suffering from the endowment effect. You are holding a bag not because of its future potential, but because of your past decision to buy it. The modern marketplace is designed to enhance this effect. Apps give you badges for holding. Communities shame you for paper handing. They are using Thaler's principle to turn you into exit liquidity. The modern takeaway here is ruthless detachment. A stock or a coin does not know you own it. It does not care about you. If you wouldn't buy the asset today at the current price, you should not be holding it. You must learn to mark your portfolio to market every single day, stripping away the emotional weight of ownership. Closely related to this is the sunk cost fallacy, a concept Thaler explores through everyday examples like sports tickets. Imagine you pay $100 for a ticket to a football game. On the day of the game, there is a massive blizzard. Driving to the stadium is dangerous and miserable. An econ would stay home. The $100 is gone regardless. So the decision should be based only on safety and enjoyment. A human, however, drives through the blizzard because they don't want to waste the money. Thaler points out that this is irrational. You are risking your life to save money that is already spent. You are paying twice, once with your wallet and once with your misery. In the current tech landscape, the sunk cost fallacy is the primary business model of the subscription economy in the SaaS, software as a service, industry. Look at your bank statement. You are likely paying for streaming services, productivity apps, or gym memberships you rarely use. Why don't you cancel? Because I've already paid the year, or I've invested so much time setting up this profile. This is sunk cost. In the world of trading, this manifests as averaging down on a loser. You bought a tech stock at $100. It drops to $80. The fundamental thesis is broken. Maybe the company lost a key contract, but instead of selling, you buy more at $80 to lower your cost basis. You're throwing good money after bad to try and salvage the emotional pain of the initial loss. You are driving through the blizzard. The modern operator must develop a zero-based mindset. Ask yourself, if I had zero exposure to this investment right now, would I enter a new position? If the answer is no, you must sell. The market does not owe you a refund on your sunk costs. Thaler then introduces us to the concept of mental accounting. This is a tendency for humans to categorize money into different buckets in their heads, treating a dollar in one bucket differently than a dollar in another. For example, people will drive across town to save $10 on clock radio, but they won't drive across town to save $10 on a new car. To an econ, $10 is $10. To a human, the $10 saving on the radio feels huge, a high percentage, while the $10 saving on the car feels irrelevant, a low percentage. We also treat salary differently from bonuses or tax refunds. We treat salary as serious money for bills, but tax refunds as free money for vacations. This cognitive error is absolutely rampant in the crypto and high-risk trading environments of today. It is most visible in the house money effect. Let's say you invest $5,000 in a speculative asset, and it goes up to $10,000. You take out your initial $5,000. Now you have $5,000 of profit left in the market. Most traders mentally label this as house money. They take wild, reckless risks with this $5,000 that they would never take with their hard-earned salary. They leverage it 100x on a futures contract. When they lose it, they say, "Oh, well, I didn't lose anything, it was just house money." Thaler argues that this is a lie. That $5,000 was yours. It was in your account. You could have bought groceries with it. You could have compounded it by labeling it house money. You gave yourself permission to incinerate it. In the era of high volatility, you must merge your mental accounts. $1 in your checking account is identical to $1 in your unrealized capital gains. Wealth is fungible. Do not let mental accounting justify gambling behavior. Moving deeper into the mechanics of the market, Thaler explores the concept of the winner's curse. This phenomenon occurs in auctions where there are many bidders. The winner of the auction is typically the person who has the most optimistic evaluation of the item's worth. Therefore, the winner almost always overpays. If the average estimate of a jar of coins is $50, but you bid $75 and win, you have likely lost money. Thaler showed that in competitive bidding environments, winning is often losing. Pivot this to the venture capital and IPO, initial public offering, mania of the 2020s. We see the winner's curse play out every time a hot AI startup raises money or a new tech company goes public. Retail investors rush in, desperate to win an allocation of shares. They bid the price up in the pre-market or on opening day. If you're a retail investor and you actually manage to buy shares of a hot IPO at the offering price, you should be terrified. Why? Because if the smart money institutional investors thought it was a good deal, they would have bought it all. If it filtered down to you, it means the insiders passed. You are the winner of the auction, which means you are the sucker. In the age of hype cycles, where AI wrappers and vaporware create massive FOMO, you must be wary of crowded trades. When everyone is trying to get into a specific coin or stock, the winner's curse is in full effect. The price is detached from reality. The Capitura strategy is to be the person selling into the auction, not the one bidding. Thaler also tackles the issue of fairness, a concept that traditional economists despise. To an econ, if demand for snow shovel spikes during a blizzard, the store should raise the price to equilibrium. It's simple supply and demand. But Thaler found that humans hate this. We view it as gouging. If a company violates our norms of fairness, we punish them, even if it hurts us to do so. We will boycott a store that gouges us, even if it's the most convenient store. This dynamic is currently playing out in the war over dynamic pricing and the gig economy. Think about Uber's surge pricing. We have grudgingly accepted it for rides. But when Ticketmaster tries to use dynamic pricing for concerts, or when Wendy's suggests dynamic pricing for burgers, the public revolt is massive. Companies are trying to use AI to maximize revenue by extracting the maximum willingness to pay from every single customer at every single moment. This is the dream of the econ. But Thaler predicts this will backfire. Brand loyalty is built on perceived fairness. If a customer feels they're being algorithmically exploited, that the price is high just because the AI knows their battery is low, they will defect. For the modern entrepreneur or business owner listening, the lesson is clear. Do not optimize for short-term profit at the expense of long-term fairness. You might extract an extra 20% today using a clever pricing algorithm, but you will destroy the customer relationship forever. In a world of infinite choice, fairness is a competitive moat. We must then confront the biological reality of self-control. Thaler models this as a conflict between two selves, the planner and the doer. The planner is a version of you that wants to retire rich, have six-pack abs, and learn a new language. The doer is the version of you that exists in the present moment, wants to eat pizza, scroll TikTok, and buy 0DT, 0 days to expiration. Options for thrill. Standard economics assumes the planner is in charge. Reality shows the doer is usually at the wheel. In the digital age, the doer is being weaponized against the planner by design. Every app on your phone is engineered by behavioral psychologists to trigger the doer. The swipe to buy interface, the confetti animations when you make a trade, the infinite scroll, these are nudges designed to bypass your rational planner. Thaler's solution is not to rely on willpower, because willpower is a depleting resource. His solution is commitment devices. You must bind your future self, just as Ulysses bound himself to the mast to resist the sirens. How do we apply this in 2025? You cannot trust yourself to trade responsibly when the market is crashing. You must use technology to handcuff your inner doer. This means setting hard, automated stop losses that you cannot override. It means using time-lock vaults of your crypto, where you literally cannot withdraw funds for 24 hours, giving your planner time to regain control. It means using app blockers to prevent you from checking your portfolio every 5 minutes. The doer wants dopamine. The planner wants wealth. You must build an infrastructure that forces the doer to submit. Automation is the ultimate commitment device. If your savings are deducted from your paycheck before they hit your checking account, the doer never sees the money to spend it. This is how you win. You rig the game against your own worst impulses. Thaler devotes a significant portion of Misbehaving to the efficient market hypothesis, EMH. The EMH has two components. The price is right. Asset prices reflect intrinsic value, and no free lunch. You can't beat the market. Thaler disagrees with the first, but respects the second. He argues that while it is very hard to beat the market, no free lunch, prices are often wildly wrong. The price is not right. This distinction is crucial for the modern investor. Just because it is hard to generate alpha, beat the market, does not mean the market is rational. Look at the meme stock phenomenon of GameStop and AMC. The prices were clearly wrong. They were detached from any fundamental reality of the business. An econ would say this is impossible. Thaler would say this is inevitable when you have a herd of humans acting on social signals rather than financial ones. However, Thaler warns that betting against the bubble is dangerous. As the famous saying goes, the market can remain irrational longer than you can remain solvent. Just because you know the price is wrong doesn't mean you can short it and win. The modern takeaway is to recognize bubbles without participating in them, and certainly without shorting them too early. We live in a world of narrative economics, where the story drives the price for a long time before the math catches up. Respect the narrative, but trust the math. This leads us to the concept of narrow framing. Humans tend to evaluate risks in isolation rather than as part of a big picture. If you ask someone if they want to take a bet with a 50% chance of winning $200 and a 50% chance of losing $100, many will refuse because the pain of losing $100 is too intense, loss aversion. But if you ask them if they want to take that bet 100 times in a row, they will accept because the law of large numbers guarantees a profit. In the age of the smartphone, we are suffering from hyper-narrow framing. We check our portfolios 10, 20, 50 times a day. Every time we check and see red, we feel the pain of loss. This frequent checking makes us more risk-averse and prone to panic selling. If you check your portfolio once a year, you see a smooth trend. If you check it once a minute, you see violent volatility. Thaler's advice is counterintuitive but essential. Look at your investments less often. The more frequently you look, the more noise you see, and the more likely you are to make a human mistake. In 2025, data is abundant, but attention is the scarce resource. By constantly checking prices, you are paying an emotional tax that degrades your decision-making ability. Thaler also explores the concept of nudges and choice architecture. A nudge is a subtle change in the environment that influences behavior without forbidding any options. For example, putting fruit at eye level in a cafeteria increases fruit consumption. This is libertarian paternalism, steering people toward better choices while leaving them free to choose. In the digital realm, you're being nudged every second, but usually toward profit for the corporation, not benefit for you. The default option is the most powerful nudge in existence. When you sign up for a service, is auto-renew checked by default? That's a nudge. When you open a trading app, is the default view the top movers, inducing FOMO? That's a nudge. You must become a choice architect for your own life. Redesign your digital environment. Change the defaults. Turn off notifications. Rearrange your home screen so that the trading app is buried in a folder and the meditation app is front and center. You cannot win a battle of willpower against a supercomputer, but you can win a battle of architecture. If you make the bad behavior hard and the good behavior easy, you will naturally drift toward wealth. Let's delve deeper into the conflict between theory and practice in finance. Thaler discusses a closed-end fund puzzle. These are funds that trade on the stock market, but own a specific basket of assets. Rationally, the price of the fund should exactly equal the value of the assets it owns, net asset value or NAV. But in reality, they often trade at a discount or a premium. This is proof that sentiment drives prices, not just value. This is perfectly mirrored in the crypto world with the Grayscale Bitcoin Trust, GBTC Saga, or the pricing of wrapped tokens. We often see assets that should be equal trading at different prices due to liquidity, convenience, or pure speculation. This creates arbitrage opportunities for the econs, the algos, but traps the humans. Don't assume that just because asset A is backed by asset B, they will trade in lockstep. The sentiment gap is real. In 2025, monitoring the premium or discount of derivatives relative to their underlying assets is a key sentiment indicator. When the premium is high, greed is rampant. When the discount is deep, fear is dominant. Use this as a compass. Finally, Thaler reflects on the evolution of economics itself. He had to fight the establishment for decades to get his ideas taken seriously. The old guard defended the rational actor model not because it was true, but because the math was elegant. It was easy to model. Modeling actual humans is messy and hard. This brings us to the ultimate philosophy of misbehaving, skepticism of elegant models. In the AI era, we are presented with incredibly elegant models. This trading bot has a 99% win rate. This economic model predicts a soft landing. This tokenomics model guarantees stability. Thaler teaches us to mistrust elegance. Real life is messy. Real markets are broken. Real people are irrational. If a model looks too perfect, it is assuming you are an econ. It is assuming liquidity will always be there. It is assuming correlations will hold. When the crisis hits, when the black swan arrives, the econs and the model vanish, and only the panicked humans remain. You must stress test your financial life for human behavior. Do not build a financial plan that requires you to be perfect. Build a plan that allows you to be flawed. Build a portfolio that can survive you making a mistake. Build a life that accounts for your laziness, your fear, and your greed. Richard Thaler's Misbehaving is not just a history of behavioral economics. It is a mirror. It forces us to look at the cracks in our own rationality. It tells us that we are not the masters of our own minds that we think we are. We are biased, emotional, and easily nudged. But there is hope in this diagnosis. Once you accept that you are a human and not an econ, you can stop pretending. You can stop beating yourself up for not being a robot. You can start building guardrails. You can start ignoring the noise. You can start recognizing when the endowment effect is making you hold a bag, or when mental accounting is making you gamble. The market is a mechanism for transferring wealth from the impatient to the patient, from the emotional to the disciplined, from the human to the econ. You may never become a full econ, but by reading this book, you can learn to misbehave a little less. I want you to open your banking or trading app right now. Find one sunk cost, a subscription you don't use, or a losing position you are holding solely because you don't want to realize the loss. Kill it, sell it, cancel it. Do it today. Break the psychological chain. And then subscribe to Captura, because we are the commitment device you need to stay rational in an irrational world. We plunge deeper into the labyrinth of human error, moving from the individual psychology of the consumer to the high-stakes, high-testosterone arena where misbehaving exposes the most embarrassing failures of the so-called experts. Richard Thaler did not just study students in a classroom. He studied the decision-makers who manage billions of dollars and run professional sports franchises. His analysis of the National Football League, NFL, draft is perhaps the most damning evidence ever collected against the rational actor model, and hold a mirror up to the venture capital and crypto pre-sale mania of 2025. Thaler and his colleague Cade Massey looked at the NFL draft, a marketplace where teams buy human talent. The price of a player is the draft pick used to select them. A high pick early in the first round is very expensive in terms of trade value, while a lower pick is cheap. The econ theory says that the market for players should be efficient. Teams should pay exactly what a player is worth. But Thaler found a massive inefficiency. Teams consistently overvalued the right now picks, the top selections in the current year, and massively undervalued future picks and lower round selections. Teams were willing to trade a fortune in future assets just to move up a few spots to grab a star player. Thaler's data showed this was mathematically stupid. The star players chosen at the top often flopped, or were only marginally better than players chosen much later for a fraction of cost. The signal was that drafting is a crapshoot. No one is good at predicting who will be a superstar. Therefore, the optimal strategy is not to put all your eggs in one basket, one high pick, but to trade down and get more picks, more lottery tickets. But GMs didn't do this. Why? Overconfidence and recency bias. They looked at the highlight reel of the college star and thought, I know for a fact this guy is the next Tom Brady. They were hedgehogs in a world that required foxes. In the digital investment landscape of 2025, the NFL draft anomaly is replicated every single day in the world of venture capital and initial DEX offerings IDOs. We see retail investors and even professional VC firms fighting to get into the seed round of the latest hyped AI protocol or Layer 1 blockchain. They pay exorbitant valuations for a project that has no product, no users, and only a white paper, simply because it is the shiny object of the moment. They are overvaluing the early pick. Just like the NFL GMs, they are confident they can pick the winner. But the data shows that the vast majority of these early-stage stars go to zero. The Captura strategy, borrowed from Thaler's findings, is a trade-down approach. Instead of fighting to get into the overhyped, overpriced hot deal, where you have to lock up your capital for years, wait. Let the market filter the noise. By the second rounders, the projects that have survived the initial hype cycle have built a real product and are now trading at a discount because the herd has moved on. In a world of uncertainty, volume of bets often beats the precision of bets. Don't try to be the sniper, be the shotgun. This leads us directly into one of the most profound concepts in behavioral finance: myopic loss aversion. This is a psychological mechanism that explains the equity risk premium puzzle. Historically, stocks have massively outperformed bonds over the last century. The difference is so huge that it doesn't make sense for any long-term investor to hold bonds, yet millions do. Why? Because stocks are volatile. Thaler explains that if you check your portfolio every day, you will see it go down about 50% of the time. Every time you see it go down, you feel the sting of loss. And as we know from prospect theory, losses hurt twice as much as gains feel good. This creates a psychological asymmetry. The frequent checker experiences a net emotional loss, even if the portfolio is flat. To avoid this pain, they retreat to safe, low-yield assets like bonds or cash. They pay a massive insurance premium in the form of loss of returns, just to avoid the emotional pain of seeing red numbers on a screen. Now, pivot this to the year 2025. We have built a financial infrastructure designed to maximize myopic loss aversion. In the 1980s, you checked your stock prices in the newspaper the next morning. Today, you have a supercomputer in your pocket that pushes a notification to your lock screen the second your portfolio drops by 5%. We are not just checking daily, we are checking minutely. The myopia has gone from 24 hours to 24 milliseconds. This creates a generation of hyper-anxious traders who are psychologically incapable of holding an asset for the long term. The volatility of crypto, which trades 24/7/365, amplifies this to a breaking point. The crypto risk premium is huge because the emotional toll of holding an asset that can drop 30% while you are sleeping is excruciating. The modern takeaway is that your phone is an intuition pump that is broken. It is feeding you noise that triggers your loss aversion. If you want to capture the massive returns of the signal, secular growth trends, you must artificially blind yourself to the short-term volatility. This is not just advice. It is a tactical instruction. Delete the widgets from your home screen. Turn off price alerts. If you are a long-term holder, there is literally no reason for you to know the price of Bitcoin on a Tuesday afternoon. Knowing the price only tempts you to make a doer mistake. You must understand that the premium you earn in the market is not just for risking capital. It is payment for enduring pain. If you can endure the pain of volatility without looking, you earn the premium. If you look, you sell, and you forfeit the premium to someone with a stronger stomach. Thaler then escorts us into a funhouse mirror of game theory, specifically the Keynesian beauty contest. John Maynard Keynes, a famous economist, described the stock market not as a calculation of value, but as a newspaper beauty contest where the prize goes to the person who picks the face that everyone else thinks is the prettiest. You are not picking who you think is pretty, fundamental value. You are not even picking who the average person thinks is pretty, first-level thinking. You are picking who the average person thinks is pretty, second-level thinking. It is an infinite regress of guessing what others are guessing. But when Thaler played this game with real people, even economists, the winning number was never zero. It was usually around 20 or 30. Why? Because there are always level 0 and level 1 thinkers in the pool. If you are too smart and guess 0, you lose. You have to be exactly 1 step ahead of the crowd, not 10 steps. In 2025, the meme economy and PvP, player versus player, markets are the purest implementation of the Keynesian beauty contest in history. When you buy a meme coin like Dogwafat or Pepe, there's no fundamental value. There are no earnings. There's only the beauty contest. You are betting that other people will find a meme funny/cute/valuable. The modern takeaway is that you cannot trade these markets like an econ. If you look at a meme coin and say, this has a P/E ratio of infinity, it's worth 0. You are the guy guessing 0 in the game. You are rationally right, but financially dead. You will get run over by the herd. To win in the attention economy, you must profile the participants. Are the participants mostly retail level 0 thinkers? Then bet on the simple, funny dog. Are the participants cynical insiders level 2? Then bet on the meta commentary. You must gauge the depth of thinking of the market. But be warned, this is a dangerous game. It is musical chairs. When the music stops, the attention shifts. The value evaporates instantly because there was never any fundamental floor to catch it. Let's now examine the darker side of Thaler's work, the status quo bias and the power of defaults. Thaler discovered that humans are profoundly lazy. We stick with the default option. In countries where organ donation is opt-in, you have to check a box to donate. Donation rates are low. In countries where it is opt-out, you have to check a box not to donate. Rates are near 100%. The effort of checking a box is trivial, but the nudge of the default is powerful. In the digital subscription economy, corporations have weaponized the status quo bias. They offer free trials that auto-convert to paid subscriptions. They know that 80% of people will be too lazy or forgetful to cancel. This is sludge, a nudge that hurts you, but you can flip this jujitsu on itself. You can weaponize your own laziness for wealth creation. This is a philosophy of automation over discipline. If you have to decide to invest every month, you will fail. You will forget, or you'll get scared by a headline. But if you set up an automatic buy dollar cost averaging that pulls from your bank account the day you get paid, status quo bias works for you. Your default state becomes investing. To stop investing, you would have to log in and cancel, and your laziness prevents that. The Captura protocol is to audit your defaults. Go through every area of your life. Is the default setting on your browser tracking you? Change it. Is the default setting on your 401k a low-yield cash fund? Change it to an index fund. Is the default setting of your evening routine watching Netflix? Unplug the TV so the default is reading. You are the architect of your own path of least resistance. Thaler also delves into probability neglect, specifically regarding low probability, high impact events. We tend to overweight small probabilities. This is why people play the lottery. The difference between a 0% chance and a 0.00001% chance feels huge to a human, even though it is mathematically negligible. We buy the ticket for the dream, not the probability. Conversely, we underestimate high probability risks like heart disease while overestimating low probability risks like shark attacks or terrorism, because the latter are more available to our imagination availability heuristic. In the trading world of 2025, this manifests an explosion of zero DTE, 0 days to expiration, options, and highly leveraged crypto futures. Traders are buying lottery tickets every day. They are paying a premium for positive skew, a small chance of a massive 1000x payout. The market makers, the econs, are happily selling these lottery tickets, collecting the premium, and grinding the retail traders to dust. On the flip side, people neglect the high probability of ruin from leverage. They think, I won't get liquidated. Even though the math says if you play long enough with high leverage, liquidation is a certainty. The signal here is to sell the lottery tickets, not buy them. Or, if you must speculate, treat it as entertainment expense, not investing. Never confuse a lottery ticket with a retirement plan. We must also confront hindsight bias, the I knew it all along phenomenon. Thaler explains that once an event happens, our brains rewrite our memories to make the event seem inevitable. After the 2008 crash, everyone claimed they saw the signs. But if you look at the records, almost no one actually predicted it. Hindsight bias is dangerous because it prevents us from learning. If you think you knew it all along, you don't examine the flaws in your process that led you to be surprised. In the era of influencer finance, hindsight bias is industrial strength. You will see gurus deleting their wrong predictions and retweeting their lucky guesses with the caption, "Told you so." This creates a false reality where everyone is a genius. For the Capitura listener, the antidote is a prediction journal. You cannot trust your memory. You must write down your predictions and your reasons in real time. Timestamp them when you are wrong, and you will be. Force yourself to read your old logic. I thought Bitcoin would drop because of the regulation news. It went up. Why was I wrong? Did I overestimate the regulation? Did I miss a demand shock? This process audit is the only way to calibrate your intuition. Without a journal, you are doomed to repeat the same mistakes while convincing yourself you are getting smarter. Let's dig deeper into the concept of fairness, which we touched on earlier, but specifically in the context of the labor market and wage stickiness. Thaler observed that employers rarely cut wages, even in recession. Why? Because cutting wages is seen as unfair and destroys morale. Instead, they fire people. It is psychologically better to fire 10% of the staff who disappear than to cut everyone's pay by 10%, leaving a building full of angry employees. In the modern gig economy and remote work environment, this dynamic is shifting. Algorithms don't care about morale. A gig platform can lower the pay per ride or pay per task instantly based on supply and demand. We are moving toward a world of hyperflexible wages. This is efficient for the market, econ, but brutal for the worker, human. The takeaway is that salary security is an illusion from the 20th century. In a digital labor market, your income will likely become more volatile, more closely tied to real-time output. You must prepare your personal finances for this volatility. You need a larger emergency fund or opportunity fund than your parents did, because a corporation is no longer shielding you from the fluctuations of the market. You are the CEO of You Incorporated, and the market is volatile. Thaler also explores the end-of-the-year effect, or calendar effects. He noticed that fund managers behave differently at the end of the quarter or year. If they are behind their benchmark, they take wild risks to catch up. If they are ahead, they lock in the portfolio to protect their bonus, window dressing. This calendar psychology is vital for the modern trader to understand. Markets are not continuous flows of data. They are punctuated by human milestones. The end-of-month flows, the tax loss harvesting in December, the Monday morning optimism. Crypto markets have their own rhythms. The Asia session, the US Open. You are not trading a random walk. You are trading a schedule of human habits. For example, in late December, you often see beaten down assets drop further as people sell them to claim tax losses, selling solely for tax reasons, not fundamental ones. This creates a January effect bounce where those assets recover. The fox waits for December 28th to buy the assets that the humans are dumping for tax reasons. You provide liquidity to the tax harvesting cowards, and you reap the rewards in the new year. Now let's pivot to the curse of knowledge. Thaler explains that once you know something, it is impossible to imagine what it's like not to know it. This makes experts terrible at communicating with lay people, and it makes tech creators terrible at designing products for normal users. In the crypto/DeFi/Web3 space, the curse of knowledge is a primary barrier to adoption. Developers build interfaces that only other developers can understand. They talk about slippage gas limits and private keys, assuming everyone knows what these are. They don't. This creates a massive opportunity for the translator. If you can be the bridge, the person who understands a complex text signal, but can explain it to the layman human, you will be infinitely valuable. Capitura is essentially a project in breaking the curse of knowledge. In your own business, ask yourself, am I assuming my customer knows what I know? They don't. Dumb it down. Simplify. Friction is the enemy of conversion. We must also discuss the narrative fallacy in the context of Thaler's work. Humans love stories. We digest information better if it has a protagonist, a conflict, and a resolution. Econs digest data. The financial media industry exists to turn random data, noise, into a story, narrative. The market fell today because of fears of inflation. Maybe it just fell because there were more sellers than buyers. We don't know, but the story makes us feel like we understand the world. In 2025, narrative is a tradable asset class. We see narrative trades, AI, China reopening, quantum computing. The prices of these assets move based on the strength of the story, not the cash flows. Thaler would warn you, invest in the narrative early, but do not believe the narrative. The narrative is a tool to drive the price. Eventually, the data, earnings, users will assert itself. If you are the true believer who holds a bag when the narrative breaks, you are the victim of a good story. Be a mercenary of narratives, not a missionary. Let's examine the law of small numbers. Humans incorrectly assume that a small sample size should resemble the larger population. If a coin flips heads 5 times in a row, we think tails is due, gambler's fallacy, or the coin is rigged, hot hand fallacy. We draw massive conclusions from tiny data sets. In the world of algorithmic trading and copy trading, this is lethal. You see a trader on a leaderboard who has won 10 trades in a row. You assume they're a genius. You copy them. But 10 trades is a meaningless sample size. A monkey flipping a coin could win 10 times in a row. You are betting your life savings on statistical noise. You need to see 1,000 trades to know if there's an edge. But humans don't have the patience for 1,000 trades. We want the hot hand now. The modern takeaway is to distrust short-term track records. In the age of AI, it is easy to generate fake track records or to have 1,000 bots trading and only show the one that got lucky. Demand long data. Demand audited history over multiple market cycles. If they haven't survived a bear market, they aren't a trader. They are a tourist. Thaler also touches on the concept of intersubjectivity. How our wants are mimetic. We want what others want. This drives a Veblen good effect in luxury markets, where higher prices increase demand. In the digital realm, this is the blue checkmark economy. We pay for status signals. But in 2025, digital status is fleeting. The signal of wealth used to be a Rolex. Then it was a Bored Ape NFT. Now, as AI makes digital content infinite and cheap, the signal of status is shifting back to the analog. The modern takeaway is that digital scarcity is often an illusion. True scarcity is found in the physical world: land, gold, face-to-face connection. The econ might say a digital painting is efficient. The human craves the texture of canvas. Bet on the real in a world of the fake. We must now confront the paradox of choice, a concept popularized by Barry Schwartz but integral to Thaler's nudge theory. When humans are presented with too many options, they freeze. They choose nothing. In the modern financial supermarket, you have 10,000 cryptos and 5,000 ETFs. The result? Analysis paralysis. You spend weeks researching and buy nothing, missing the bull run. Or you spread your capital so thin across 50 assets, diversification, that you dilute your gains. Thaler's advice is to artificially limit your choice set. Use a filter. I only invest in the top 5 assets by market cap. I only invest in founders who have exited before. By imposing artificial constraints, you liberate your decision-making ability. Creativity and action thrive under constraints. They die in infinite freedom. Finally, in this segment, we touch on altruism and punishment. Thaler showed that humans are willing to lose money to punish someone who is behaving unfairly. This is the ultimatum game. If I offer to split $10 with you, giving you $1 and keeping $9, and econ would accept the $1 because $1 is better than $0. A human will reject the offer, causing both of us to get $0, just to say screw you to my unfair offer. This drive for altruistic punishment is the engine of cancel culture and corporate boycotts. In the digital age, a brand to be destroyed overnight if it violates the tribe's fairness norms. As an investor, this introduces reputational risk as a major variable. You cannot just look at the balance sheet. You have to look at the social credit. Is this company one tweet away from being canceled? The ESG, environmental social governance movement, despite its flaws, is an attempt to price in this human desire for fairness. The signal is not go woke, but don't be a target. Companies that fly under the radar of the culture war are often the safest bets. As we conclude this deep dive into the second movement of Misbehaving, the pattern should be becoming clear. The econ is a myth. The human is a reality. The market is not a calculator. It is a carnival. The NFL GMs are gambling. The venture capitalists are herd following. The retail traders are playing the lottery. The long-term investors are fighting their own biology. You are standing in the middle of this carnival. The lights are flashing. The barkers are shouting, and everyone is trying to pick your pocket, including your own brain. But now, you have the schematics of the rides. You know the games are rigged. You know the house money is a lie. You know the sunk cost is a trap. You are starting to see the matrix code behind the candlestick charts. We now advance into the machinery of wealth creation itself, dissecting perhaps the most impactful contribution Richard Thaler has made to the financial lives of millions, the architecture of retirement savings and the Save More Tomorrow program. Thaler recognized a fundamental flaw in the human operating system known as present bias or hyperbolic discounting. We value the present moment infinitely more than the future. A burger today is worth more to our doer self than a fit body next year. A new iPhone today is worth more than a comfortable retirement in 2050. This bias makes saving money painful. It feels like a loss. You are taking money away from your current self to give it to a stranger, your future self. And because humans are loss-averse, we resist this. Thaler's solution was brilliant in its simplicity. He didn't try to change human nature. He leveraged it. He created a program where employees commit now to save a portion of their future raises. Why does this work? First, because the money is coming from a future raise. You don't feel the loss in your current paycheck. Your take-home pay never goes down. It just goes up less than it would have. Second, because the commitment is to the future, your rational planner self is allowed to make the decision, bypassing the greedy doer self. This program, known as Smart Save More Tomorrow, has generated billions of dollars in wealth for workers who otherwise would have spent it all. In the digital landscape of 2025, the application of Save More Tomorrow has evolved into auto-escalating wealth algorithms. You no longer need an HR department to set this up. You can program it yourself using modern fintech tools. The modern takeaway is to decouple your spending power from your earning power. When you get a raise, a bonus, or a lucky trade in crypto, your immediate instinct is lifestyle creep. Buying a better car, a bigger apartment. This is the doer consuming the surplus. You must build an auto-sweep protocol. If your income hits your bank account, a script should immediately move 50% of the surplus into an investment account before you even see it. You are essentially hacking your own mental accounting. If you don't see the money in your checking account, you psychologically assume it doesn't exist, and you adjust your spending downward. In the world of DeFi decentralized finance, this is even easier. You can use yield redirects, where the interest earned on your stablecoins is automatically sent to buy Bitcoin or Ethereum. You are compounding your wealth without ever having to make a conscious decision to save. You are making wealth the default state and poverty the optional state. We must then pivot to the dark side of mental accounting. The curse of buy now, pay later, BNPL. Thaler observed that humans separate the pain of paying from the pleasure of consuming. Credit cards are the first step in this decoupling. They anesthetize the pain of paying. You swipe a piece of plastic or now tap a phone, and you get the product immediately. The bill comes 30 days later, by which time the pleasure of the purchase has faded, leaving only the dull ache of debt. In 2025, services like Klarna, Afterpay, and Affirm have taken this weaponized psychology to a nuclear level. They allow you to split a $50 t-shirt into 4 easy payments of $12.50. This exploits narrow framing and anchoring. You anchor on the small number, $12.50, rather than the total cost. It feels cheap, but this creates a debt snowball. You have 20 different small payments running simultaneously, bleeding your cash flow dry. Thaler would argue that this is predatory choice architecture. It is designed to bypass your planner self entirely. The Capitura defense is strict. You must recouple the pain with the purchase. If you cannot pay cash for a consumer good, clothes, electronics, dining, you cannot afford it. Do not use BNPL. It is a trap that leverages your present bias to enslave your future self. Reintroduce the friction. Pay with debit. Pay with cash. Feel the money leaving your hand. The pain is the signal that keeps you solvent. Let's dig into the value versus growth anomaly, one of Thaler's most controversial findings in the investing world. Efficient market theory says that growth stocks, high-flying tech companies, and value stocks, boring industrial companies, should have the same risk-adjusted returns. But Thaler found that value consistently outperforms growth over long periods. Why? Because of human overreaction. Investors get too excited about the glamorous stocks. They project the current massive growth into infinity. They bid the price up to impossible levels, the winner's curse. Conversely, they get too pessimistic about the boring or struggling companies. They assume the loser will lose forever. This creates a mispricing. The glamour stock is priced for perfection and inevitably disappoints, mean reversion. The loser stock is priced for bankruptcy and inevitably surprises to the upside. In the AI-dominated market of the mid-2020s, this lesson is critical. We are seeing glamour on steroids. Companies with AI in their pitch deck are trading at 100x revenue. The herd assumes that NVIDIA or OpenAI will grow at 50% forever. Thaler's ghost is screaming that this is a behavioral error. The modern takeaway is to look for the unloved. Where's the pessimism? Perhaps it is in energy or commodities or traditional banking. These sectors are unsexy. They are boring. But because they are hated, they are cheap. And because they are cheap, the bar for them to succeed is low. The fox buys the assets that the hedgehog hates. The fox understands that mean reversion is the most powerful force in finance. Trees do not grow to the sky. Eventually, the hot tech stock slows down and the valuation collapses. Eventually, the hated oil company pays a massive dividend and the valuation recovers. Be a contrarian, not for the sake of being difficult, but for the sake of the math. This brings us to the dividends as free money fallacy. Thaler notes that irrational investors love dividends. Rationally, a dividend is tax inefficient. The company pays tax on the income, then pays you and you pay tax again. It would be better for the company to just buy back shares, raising the stock price, or reinvest for growth. But humans love the bird in the hand. We trust the cash check in the mail more than the fluctuating stock price on the screen. In the crypto age, this has mutated into yield farming and staking rewards. Investors will buy a terrible inflationary token just because it offers 100% APY, annual percentage yield. They see the passive income rolling in daily and think they are geniuses. But they are suffering from a severe cognitive error. If the token price drops by 90%, your 100% APY is worthless. You're getting paid in a currency that is hyperinflating. This is a dividend fallacy on blockchain steroids. The signal is total return, price appreciation plus yield. Do not look at the yield APY in isolation. That is a vanity metric used to lure in the doer who wants free money. Always ask, where is the yield coming from? If the yield comes from printing more tokens, you are the yield. You are being diluted. We must also explore anchoring in the context of negotiations and valuation. Thaler explains that when we are uncertain about the value of something, we grab onto any available number, even an irrelevant one, and use it as an anchor. If I ask you, is the population of Turkey greater than 300 million? And then ask you to guess the population, you will guess a high number. If I ask, is it greater than 5 million? You will guess a low number. The initial number anchors your estimate. In the volatile world of 2025, anchoring is the primary driver of bag holding. You bought a stock at $100. It goes to $150, the all-time high. Then it drops to $80. You refuse to sell at $80 because you are anchored to the high of $150. You view $150 as a real value and $80 as a discount. You tell yourself, I'll sell when it gets back to $150. But the market doesn't know about the $150. The $150 was a temporary spike caused by hype. The real value might be $50. By anchoring to the high, you ride the asset all the way down to zero. The Captura strategy is to reset the anchor. Every morning, look at the current price. Forget the price you bought it at. Forget the all-time high. Ask, is it a buy at this price today? If not, sell. Do not let the ghost of past prices haunt your future decisions. Furthermore, we see anchoring in unit bias. Retail investors love cheap coins. They buy Shiba Inu or Pepe because the price is $0.00001. They think, if this goes to $1, I'll be a billionaire. They are anchored to the unit price of 1. They fail to understand market cap. For Shiba Inu to reach $1, it would need a market cap larger than the entire global economy. But the human brain struggles with large numbers, market cap, and easily grasps small numbers, unit price. Scammers know this. They deliberately price tokens with 12 zeros to exploit your unit bias. The modern takeaway is to ignore the unit price completely. Look only at market cap and liquidity. A Bitcoin at $100,000 might be cheaper, better value, than a penny stock at 1 cent. Let's touch on the endowment effect again, but this time in the context of data ownership and Web3. Thaler showed we overvalue what we own. In the Web 2 era, Facebook, Google, we gave away our data for free because we didn't feel like we owned it. It was intangible. Now, with the rise of Web 3 and data wallets, people are beginning to feel ownership of their digital footprint. This suggests a massive shift. As people realize their data has value, the endowment effect will kick in. They will refuse to give it up for free. They will demand payment. This will break the ad-supported business model of the internet. The signal for the astute investor is to look for the data DAOs, decentralized autonomous organizations, and protocols that enable this monetization. We are moving from a data serfdom to a data property rights regime driven by the psychological shift of the endowment effect. Thaler also discusses libertarian paternalism, the idea that it is okay for institutions to nudge people toward better choices as long as they don't force them. This is a philosophical core of Misbehaving. But in 2025, we face the threat of algorithmic paternalism that is neither libertarian nor benevolent. The algorithms that curate your news feed, your shopping results, and your dating options are nudging you constantly, but they are not nudging you toward your best interest, health, wealth, happiness. They are nudging you toward their best interest, engagement, ad revenue, outrage. This is sludge. Thaler defines sludge as friction that makes it hard to do the right thing, like a difficult cancellation process. But modern sludge is also the frictionless path to the wrong thing, like one-click gambling. You must become a nudge hunter. You must recognize when a user interface UI is manipulating you. Why is the sell button red? To induce fear. Why is the claim reward button gold? To induce dopamine. Why is the unsubscribe link gray and tiny? To use visual hiding. The modern takeaway is that UI is not neutral. UI is policy. When you interact with a digital platform, you're entering a Skinner box designed by the world's smartest behavioral psychologists. You must maintain a hostile epistemology. View the interface as an adversary until proven otherwise. Slow down. Read the fine print. Don't click the shiny button. We must also revisit the law of one price. In an efficient market, the same asset cannot trade at two different prices. Arbitrageurs would buy the cheap one and sell the expensive one until the prices converge. But Thaler showed that in the real world, limits to arbitrage exist. It is risky and expensive to short sell. In the fragmented liquidity of crypto, the law of one price is violated constantly. Bitcoin might trade at $60,000 in New York and $65,000 in Nigeria or Korea, the kimchi premium. Why? Because of capital controls and friction. You can't easily move money to arbitrage it. For the Captura operator, these inefficiencies are profit opportunities, but they are also risk indicators. If the premium gets too high, it signals a local bubble or a systemic breakdown. Don't assume the market is broken. Assume there is a hidden cost, regulation, risk of freezing that you aren't seeing. Let's explore the concept of fairness in the age of AI displacement. Thaler showed that people will punish firms that violate fairness norms. What happens when companies start replacing mass amounts of human workers with AI agents to boost profits? The econ view is, this is efficiency, stock price goes up. The human view is, this is betrayal. We may see a massive fairness discount applied to companies that ruthlessly automate. Consumers may boycott AI-only customer service. The human premium will emerge. Businesses that advertise real humans, real service might be able to charge more, tapping into our innate desire for connection and fairness. As an investor, do not just bet on the company that cuts costs the fastest. Bet on the company that manages a transition without triggering a fairness revolt. Thaler also delves into the regression to the mean in sports and performance. An athlete who appears on the cover of Sports Illustrated usually performs worse the next year. The SI jinx. Is it a curse? No, it's statistics. To get on the cover, they had to have an outlier season, a 3 sigma event. The probability of repeating a 3 sigma event is near zero. They are simply regressing to their normal average. In the world of star fund managers and crypto influencers, this is the most important rule to remember. The trader who made 1,000% last year is statistically likely to underperform this year. They took excessive risks that paid off, lucky outcome. Now, either they will continue taking those risks and blow up, mean reversion of luck, or they will become conservative to protect their reputation, and their returns will drop, mean reversion strategy. Do not chase the hot hand. Chase the robust process. A manager who makes 15% every year for a decade is infinitely better than one who makes 100% in 1 year and minus 50% in the next. Consistency is the only signal. Outliers are almost always noise. We must also discuss hindsight bias in the context of AI hallucination and deep fakes. As reality becomes more malleable, our memory becomes more vulnerable. Thaler teaches that we rewrite the past to fit the present. In a world where AI can generate fake photos of events that never happened, our collective hindsight bias will be weaponized. Gaslighting will become a service. You will see a video of a politician saying something they never said. Even if it is debunked, your brain will struggle to unsee it. It will color your priors. The Captura defense is cryptographic truth. We must move toward a world where information is signed and verified on a blockchain ledger record. Until then, you must be skeptical of your own memory. Did you really know that stock was going to crash? Or did you just read 3 articles that said it was inevitable after it happened? Keep the journal. The ink or the blockchain timestamp doesn't lie. Your brain does. Let's apply mental accounting to the concept of time. Just as we treat $100 differently depending on its source, we treat time differently. We waste hours scrolling on our phone, low value time, but stress about saving 5 minutes in traffic, high stress time. We view work time as sold to the employer, but free time as having zero opportunity cost. In the gig economy and the creator economy, all time is monetizable. This is a double-edged sword. It can lead to hustle culture, burnout, where you feel guilty for resting, because that hour costs you $100 in potential earnings. Thaler would advise us to create mental buckets for time to preserve our sanity. You must explicitly label some time as non-transactional. This is leisure time where efficiency is illegal. If you try to optimize your leisure, e.g., listening to this audiobook at 3x speed while running, you are turning leisure into work. You are engaging the econ mind when the human mind needs a rest. Protect your unoptimized time. It is the soil from which creativity grows. Now, let's look at the paradox of value, or the water diamond paradox, through a behavioral lens. Why is water essential, cheap and diamonds useless, expensive, scarcity and signaling? In 2025, we have digital diamonds, NFTs, skins, and digital water, information, bandwidth. AI is making content, text, images, code, as abundant as water. The price of generic intelligence is falling to zero. Therefore, the value will accrue to the diamonds, the things that AI cannot generate. What are they? Trust. community, physical experiences, high-stakes accountability. If you are building career, do not sell water, generic content. Sell diamonds, high-trust verification. Thaler's work suggests that humans crave meaning and status more than raw utility. Positioning yourself as the premium option, the one that signals status, is a robust strategy against the deflationary force of AI. We move to the concept of default networks. In our social lives, Thaler showed that we stick to default choices. We also stick to default people. We are friends with the people we sit next to, the people we work with. This leads to homophily. Birds of a feather flock together. This creates echo chambers. To be a fox, as Nate Silver would say, or a choice architect, as Thaler would say, you must disrupt your social defaults. You must curate your human portfolio as rigorously as your stock portfolio. Are you over-indexed on cynical people? Are you under-indexed on creative people? The nudge here is to physically place yourself in environments where serendipity is a default. Join a club that has nothing to do with your industry. Go to a conference you are unqualified for. Break the homophily. The signal of a new opportunity almost always comes from a weak tie, someone outside your inner circle. Let's dig into the peanuts effect. This is a variation of risk-taking where people are willing to take big risks with small amount of money because it's peanuts. It's only $20. I'll put it on this 1,000 to 1 parlay bet. But if you do this every week, the peanuts add up to a massive pile of wasted capital. This is the business model of the microtransaction economy. 99 cents for a skin, $2.99 for a subscription, $5 for a loot box. The friction is so low that the plan herself doesn't wake up to stop the doer. Thaler would say, aggregate the costs. Don't look at the $5 cost. Look at the $500 annual cost. Does that skin feel worth $500? Probably not. By aggregating the peanuts, you trigger the loss aversion that saves you money. We must also touch on the sunk cost education. Many of you have degrees that are becoming obsolete. You spent 4 years and $100,000 learning a skill that AI can now do in seconds. The sunk cost fallacy screams, I must keep working in this field to justify my degree. Thaler says, ignore the degree. It is a sunk cost. It is gone. The only question is, what is the best use of my time forward-looking? If the answer is learning a trade or starting a business in a totally new field, do it. Do not let a piece of paper from 2015 dictate your destiny in 2025. The market does not care about your degree. It cares about your value add. Finally, in this segment, let's explore the behavioral life cycle hypothesis. Standard economics says we smooth our consumption perfectly over our lives. We borrow when young, save when middle-aged, spend when old. Thaler says, no, we spend based on current income. We are hand-to-mouth. When we have money, we spend it. This is why windfalls are dangerous. A sudden inheritance or a crypto moonshot is often treated as consumption money rather than wealth money. The Capitura advice is to impose a cooling-off period. If you receive a windfall, put it in a 6-month treasury bill. Lock it up. Do not touch it. Allow your mental accounting to shift the label of that money from lottery winnings spendable to patrimony, sacred savings. The time delay allows the dopamine to fade and the rationality to return. As we close this third movement of misbehaving, realize that you are fighting a war on 2 fronts. The external front is the market, the algos, the nudges, the sludge, the noise. The internal front is your biology, your present bias, your loss aversion, your laziness. Thaler has given you the map of the enemy territory. You know that free is usually a trap. You know that default is usually a shackle. You know that fairness is a variable, not a constant. The goal is not to eliminate your emotions. It is to architect a life where your emotions don't bankrupt you. You want to be the choice architect of your own destiny. I want you to identify one default in your life that is costing you money or time. Is it the default route you drive that goes past the Starbucks? Is it the default homepage on your browser that shows news? Is it the default setting on your thermostat? Change one default today to favor your planner self. Just one. Prove to yourself that you can nudge yourself. We arrive now at the summit. We have dissected the flaws of the human mind and the arrogance of the econ model. We have seen how the digital world weaponizes our instincts. Now, we must synthesize this into a coherent philosophy for the future. Because the future is not just about misbehaving a little less. It is about surviving an era of perfected manipulation. As AI models become more advanced, they will not just understand behavioral economics. They will master it. They will be able to generate super stimuli, nudges so personalized and so potent that the human brain has no defense. Imagine a shopping AI that knows exactly what color, what word, what timing will bypass your prefrontal cortex and trigger a purchase. Imagine a political AI that knows exactly what fear will make you vote. We are moving from the era of nudge to the era of shove. In this impending reality, the lessons of Richard Thaler are your only armor. You must adopt a stance of radical skepticism towards your own desires. When you feel a sudden urge to buy, to click, to agree, you must pause. The pause is the only weapon that works against the algorithm. The algorithm operates at the speed of light. You operate at the speed of biology. By slowing down, you break the feedback loop. We must also reconsider the definition of wealth. To an econ, wealth is just a number on a screen. To a human, wealth is relative. We don't care if we are rich. We care if we are richer than our brother-in-law. This status anxiety is a treadmill that never ends. Thaler shows us that this is a game you cannot win because the goalposts always move. The only winning move is to step off the treadmill. Define enough. This is the ultimate behavioral hack. If you define a number that is enough, you become immune to the FOMO, the envy, and the greed that the market uses to trap you. You become an econ in the best sense, rational, detached, and content. Let's apply the pre-mortem to your entire financial life. Imagine it is 2035. You are broke. What happened? Did you get rugged in a crypto scam because of greed? Did you panic sell during the crash of 2029 because of loss aversion? Did you inflate your lifestyle until you were living paycheck to paycheck? Did you trust a guru who turned out to be a fraud? See the failure, feel it, and now, come back to 2025 and build the defenses. Diversify to prevent the rug pull. Automate the savings to prevent the lifestyle creep. Curate the information to prevent the guru trap. Write the investment policy statement to prevent the panic sell. This document, your personal investment policy statement, is the Magna Carta of your wealth. It is a contract between your planner self and your doer self. It says, I will not sell stocks unless the S&P 500 earnings drop by 20%. I will not put more than 5% of my net worth into speculative assets. I will wait 24 hours before any purchase over $100. When the storm comes, and it will come, you do not have to think. You just have to follow the orders you gave yourself when you were sane. Thaler's work teaches us that the world is not efficient. It is messy. Prices are wrong. People are irrational. But this inefficiency is your opportunity. If the market were perfectly efficient, there would be no profit left for you. It is precisely because people are misbehaving that you can make money. You make money by providing liquidity when they are panic selling. You make money by holding value when they are chasing glamour. You make money by being the adult in a room full of toddlers. You are the choice architect. You are the fox. You are the sovereign human. The noise will never stop. The nudges will never cease. But you have read the manual. You know the glitches in the software. And instead of being exploited by them, you will exploit them. You will automate your wealth. You will filter your inputs. You will bind your impulses. You will forgive your mistakes. And then you will correct them. This is the path of Captura. It is not the easy path. The easy path is to be a doer, drifting downstream, pushed by every current of marketing and emotion. The hard path is to grab the oars, engage the planner, and row upstream toward the life you deserve. We have given you the theory. The practice is up to you. Subscribe to Captura. We are your external planner. We are the voice in your ear, reminding you of the signal when the noise gets too loud. Share this audiobook with one person who needs it, someone who is misbehaving with their finances. be the nudge in their life. Now put down the phone, take a breath, and go make a rational decision. We delve now into the chaotic machinery of market correction, or rather, the lack thereof. This is a section of Misbehaving where Richard Thaler takes a sledgehammer to the invisible hand wave. Standard economic theory relies on a magical assumption. If asset prices ever got whack irrational, the smart money arbitrageurs will instantly swoop in, short sell the overpriced assets, buy the underpriced ones, and force the market back to efficiency. It's a beautiful, self-correcting ecosystem. Thaler calls this the hand wave because it dismisses reality with a gesture. In the real world, correcting the market is terrifying, expensive, and often impossible. Thaler introduces us to the limits of arbitrage. He explains that betting against a bubble is not free money. It is a death wish. To short a stock, you have to borrow it and pay interest. If the price keeps going up driven by irrational exuberance, you get a margin call. You have to put up more cash. If you run out of cash, the broker closes your position and you lose everything. Even if you were right, you can be logically correct that a stock is worth $10. But if the market pushes it to $500 before it goes to $10, you are bankrupt. This is the exact mechanic of the GameStop GME short squeeze of 2021, a modern event that Thaler's work predicted perfectly. The hedge funds, the so-called smart money, saw that GameStop was a dying retailer and shorted it. They were the econs, but they underestimated the humans, the Reddit army. The retail traders didn't care about the balance sheet. They cared about the narrative, the community, and sticking it to the man. They bought in a frenzy. The price skyrocketed. The hedge funds faced the limits of arbitrage. They ran out of collateral and were forced to buy back shares at massive losses, driving the price even higher. The dumb money broke the smart money because the smart money assumed the market was a scale, but the dumb money turned it into a voting machine. The modern takeaway for the Captura operator is profound. Never assume that smart money is in control. In the age of viral coordination, 1 million noise traders with stimulus checks and a Discord server have more capital than a billionaire hedge fund manager. Do not short the narrative. Do not stand in front of the steamroller of irrationality. The market will eventually correct, but it has no timeline, and it does not care about your solvency. Thaler deepens this by discussing Siamese twin stocks, companies that are legally the same but trade on different exchanges at different prices. He uses the example of Royal Dutch Shell. Rationally, the shares should move in perfect lockstep. In reality, they diverge wildly based on local sentiment. If the Dutch are optimistic, the Amsterdam shares rise relative to the London shares. This violates the law of one price. In 2025, we see the Siamese twin anomaly in the world of wrapped tokens and liquid staking derivatives in crypto. Theoretically, wrapped Bitcoin, WBTC, on Ethereum should trade exactly at the price of Bitcoin, BTC. But it doesn't. It trades at a slight discount or premium based on the fear of the bridge custodian. We see staked Ethereum, SDTH, trading at a discount to ETH during panic events. The econ sees an arbitrage opportunity. The human sees risk. The disconnect represents the price of trust. When you see these assets depeg, do not just blindly buy the discount thinking it's free money. Thaler teaches us that the discount exists for a reason, usually a hidden risk or a liquidity trap. The gap is not an error. It is a signal of systemic stress. We must then pivot to the concept of the noise trader. Thaler defines noise traders as investors who make decisions based on false signals, noise, rather than fundamental news. In traditional models, noise traders are supposed to be eaten alive by smart money. They should lose their money and exit the market. But Thaler argues that noise traders actually create their own space. They create risk for the rational traders. If there are enough noise traders, they can drive the price so far from reality that the rational traders have to retreat. In the 24/7 digital markets, noise traders are now the dominant species. They are trading based on Elon Musk's tweets, astrological charts, and green laser eye memes. Because they are the majority volume in many assets like meme coins, they become the market. The fundamental value becomes irrelevant. The asset is worth what the noise traders say it is worth. This creates a self-fulfilling prophecy. If the noise traders believe a coin will go up because it has a cute dog on it, they buy The price goes up, and their irrational belief is validated. This attracts more noise traders. The bubble inflates. As a rational actor, a fox, you cannot ignore the noise traders. You must track them. You track their sentiment on social media. You track their leverage on exchanges. You do not join their cult, but you respect their power. You ride their wave, but you get off before they hit the rocks. Let's move to the corporate application of behavioral economics, the nudge unit, and the ethics of influence. Thaler famously helped set up a behavioral insights team in the UK government to help citizens make better choices, like paying taxes on time, using simple text message nudges. This was nudging for good. But in the private sector of 2025, we are seeing nudging for profit, often called sludge or dark patterns. Thaler defines sludge as friction introduced to prevent you from acting in your own best interest. The most classic example is a Roach Motel. Easy to check in, impossible to check out. Think about how easy it is to subscribe to Amazon Prime or a digital newspaper. One click. Face ID. Done. Now try to cancel. You have to find a hidden menu. Click through 3 pages of "Are you sure?" Maybe even call a phone number during business hours. This is weaponized behavioral psychology. The friction is calculated to exhaust your doer self. The Capitura defense against sludge is virtual cards and burner emails. Never give a subscription service your real credit card number. Use a service like privacy.com or your bank's virtual card feature to generate a unique card for that merchant. When you want to cancel, don't fight their sludge UI. Just pause the virtual card. The payment fails. They cancel you. You solve the behavioral problem with a technological solution. You become the sludge cutter. Furthermore, be aware of confusapoly. Thaler's term for when companies make pricing so complex that you can't compare options, like cell phone plans or health insurance. If you can't understand a pricing scheme within 2 minutes, assume you are being ripped off. Complexity is the camouflage of the thief. Thaler also explores disclosure as a failed remedy. Regulators think that if they force companies to disclose fees and fine print, the problem is solved. Thaler laughs at this. Humans don't read fine print. We click "I agree" instantly. In the Web3 and tech landscape, this is a terms of service farce. We sign away our privacy, our data rights, and sometimes our IP because the transaction cost of reading the legal document is too high. AI is changing this. We now have legal AI agents that can scan a 50-page to us in a second and flag the gotchas. Warning: this app claims a right to sell your photos. The modern takeaway is that you should never sign a digital contract naked. Use the AI shield. Nudge yourself to use the tool. If the AI flags a predatory clause, do not accept. Walk away. The only way to punish sludge is to deny it revenue. Let's examine incentives and the principal agent problem through a behavioral lens. Standard theory says if you pay a CEO in stock options, they will act like an owner. Thaler shows that this often backfires. The CEO agent becomes obsessed with short-term stock price to boost the value of their options rather than long-term health of the company, which the principal/shareholder cares about. They might cut R&D or fire essential staff to hit a quarterly number. In 2025, we see this in the tokenomics of crypto projects. Founders and VCs often have tokens that vest, unlock, over a short period. Their incentive is not to build a product that lasts 10 years. It is to hype the price for 12 months, dump their tokens on retail investors, and leave. This is misaligned incentives weaponized. Before you invest in any project or company, look at the vesting schedule. If the team can sell everything in a year, you are the exit liquidity. You want long lock incentives. You want to see founders who are legally bound to the ship for 5 or 10 years. That is the only way to align the human desire for quick riches with the econ requirement for long-term value. Thaler also delves into fairness in wages. He found that cutting wages is seen as unfair, but raising wages less than inflation is seen as acceptable. This is money illusion. We focus on the nominal number, the dollar amount, rather than the real number, purchasing power. In the high inflation environment of the mid-2020s, money illusion is the silent killer of the middle class. You get a 3% raise. You feel happy. I'm making more money. but inflation is 5%. You are actually 2% poorer. The corporation relies on your money illusion to cut your real wages without triggering a revolt. The Capitura mindset requires you to think in real terms. Do not measure your wealth in dollars or euros, which are melting ice cubes. Measure your wealth in purchasing power or hard assets. How many ounces of gold can you buy? How many square feet of real estate? How many hours of labor? If your income isn't tracking the price of steak and energy, you are taking a pay cut. Wake up from the money illusion. Negotiate aggressively based on real inflation, not the government CPI, Consumer Price Index number, which is often a lagging, sanitized metric. We must now pivot to mental accounting 2.0, the gamification of currency. Thaler introduced us to the idea that we treat money differently depending on its source. The modern corporation has taken this a step further by creating pseudocurrencies. Airline miles, credit card points, Starbucks stars, V-Bucks, Robux. Why do these exist? To obscure the price. When you spend 500 stars on a coffee, your brain does not register the pain of spending $5. It feels free or part of the game. This disassociates the pain of paying from consumption. In the video game industry, kids spend billions on skins using in-game currency because they bought the currency months ago, sunk cost, and the denomination is confusing. 1,000 V-Bucks equals $8.99. It confuses the internal calculator. As a sovereign individual, you must convert everything back to base currency immediately. Do not say it costs 50,000 miles. Calculate the dollar value. I could cash out these miles for $500. Is this flight worth $500? Often, the answer is no. Do not play their game. Recognizing that points are a behavioral trick to make you overspend is the first step to opting out. Furthermore, these points are fiat currency controlled by the company. They can devalue them overnight inflation by changing the redemption table. Never hold your wealth in loyalty points. Burn them as fast as you earn them. They are melting assets. Let's touch on the Peter Principle and overconfidence in management. Thaler notes that experts are often no better than algorithms, but they are much more confident. He suggests that in many fields, hiring, loan approval, medical diagnosis, a simple algorithm beats human judgment because humans are inconsistent, noisy. We have good days and bad days. An algorithm is consistent. In the age of AI, this is the managerial revolution. Middle management is being replaced by algorithms not just because it's cheaper, but because it's fairer and more accurate. An AI doesn't care if the loan applicant is attractive or has a nice smile, halo effect. It looks at the cash flow. However, Thaler would warn against algorithm aversion. When an algorithm makes a mistake, we lose all faith in it. When a human makes a mistake, we forgive it. We see this with self-driving cars. A human crashes? Tragic but normal. A Tesla crashes? National news, ban the tech. This is a behavioral bias. We demand perfection from machines but accept mediocrity from humans. The modern takeaway is to trust the base rates. Is the AI safer on average than a human? If yes, use the AI, even if it feels scary. Bet on the probabilities, not the anecdotes. The investor who overcomes algorithm aversion early will capture productivity gains, while the Luddites are still arguing about the human touch. Thaler also explores the sunk cost of beliefs. When a scientist spends 30 years working on a theory, and that theory is proven wrong, they rarely admit it. They double down. They invent epicycles to explain the anomaly. They die believing they were right. Science advances funeral by funeral. Planck's principle. In your own life, you have sunk cost beliefs. Maybe you believe that real estate always goes up. Maybe you believe hard work always pays off. Maybe you believe the government will take care of me. If the data in 2025 contradicts this, e.g., a real estate crash, AI replacing hard work, pension collapse, you'll be tempted to ignore the data to protect your ego. You cannot afford this luxury. You must be ruthless with your own worldview. Conduct a belief audit. Write down your core assumptions about how the world works. Then try to disprove them. Look for the black swan. The ability to abandon a cherished belief the moment the facts change is the ultimate sign of the fox. It is painful, but the pain of changing your mind is less than the pain of losing your fortune. Let's dig deeper into intertemporal choice and the concept of the marshmallow test. We know that delayed gratification predicts success, but Thaler nuances this. It's not just about willpower, it's about trust. The kid who waits for the second marshmallow has to trust that the researcher will actually bring it. If the environment is untrustworthy, eating the first marshmallow immediately is the rational choice. In a high-inflation, high-instability economy, rational impatience rises. If you think the currency will debase or the bank will freeze your funds, spending money now is smart. Saving is risky. This explains the behavior of Gen Z, labeled as doom spenders. They buy luxury bags and travel, instead of saving for a house they can't afford. They are not being irrational. They are responding to a broken incentive structure. They don't trust the future marshmallow. However, the Capitura philosophy argues that you must build your own trust environment. You cannot trust the system, but you can trust your own assets if you self-custody. By converting fiat, melting marshmallow, into hard assets, permanent marshmallow, you restore the incentive to save. You are no longer saving for a future that might not happen. You are storing energy in a battery that cannot be drained by the state. This restores the logic of delayed gratification. We must also revisit the curse of the status quo in the context of legacy media versus new media. Thaler shows we stick to what we know. For decades, people stuck to cable news and newspapers because it was a default. Now, the default has shifted. The new default for information is the algorithmically curated feed, TikTok, X. This carries its own behavioral risks, echo chambers, polarization. But the status quo bias of the investor is to trust the legacy brands. It was in the Wall Street Journal, so it must be true. Thaler would say, look at the incentives. The legacy media is fighting for survival. They are prone to sensationalism and narrative capture to keep subscribers. The signal often moves to the fringe before it hits the mainstream. The Wall Street Journal writes about Bitcoin after it hits $50,000. The fox was reading the white paper when it was $100. To find alpha, you must overcome the status quo bias of your information sources. You have to be willing to read the weird blogs, the technical discords, the raw data. By the time it's a headline, the alpha is gone. The headline is the exit signal. Let's focus on crowding out of intrinsic motivation. Thaler discusses how paying people to do something they act of kindness can actually reduce their willingness to do it. If you pay someone to donate blood, they might stop doing it because it feels like a transaction rather than a moral act. In the Web3 world, we see this with play-to-earn gaming. Gamers used to play for fun, intrinsic. Then crypto introduced rewards, extrinsic. Suddenly, the game became a job. When the token price crashed, the players quit. The intrinsic joy was crowded out by the financial incentive. The modern takeaway for entrepreneurs and creators is, be careful what you monetize. If you turn your hobby into a side hustle, you might destroy the joy that made you good at it. Some things should remain unfinancialized. Keep some holy ground in your life where the market is not allowed to enter. This preserves your mental health and prevents burnout. Thaler also touches on the illusion of validity. We think we see patterns in random data. We see a head and shoulders pattern on a chart and think it predicts a drop. Thaler points out that if you show people random sequences of coin flips, they will invent elaborate theories to explain them. In the era of technical analysis, influencers, the illusion of validity is a multi-billion-dollar industry. People pay for courses to learn how to read tea leaves on a chart. While some quantitative signals work, most manual TA is basically financial astrology. It works only because of self-fulfilling prophecy. If everyone looks at the same line, they act together. But relying on it is dangerous. The Capitura approach is to trust macro and mechanism. Why is the asset valuable? Who is buying it? What is the liquidity? These are real forces. Lines on a chart are psychological shadows. Do not bet the farm on a shadow. We must also explore the focusing illusion. Nothing in life is as important as you think it is while you are thinking about it. When you are obsessed with a specific stock or a political election or a breakup, it feels like the entire world. It consumes your bandwidth. You make rash decisions to alleviate the immediate stress. The news cycle is an engine for generating focusing illusions. Every week, there is a current thing that is supposedly the end of the world. A spy balloon, a bank failure, a viral debate. If you react to every current thing, your portfolio will be churned to death. You must practice strategic ignorance. Ask, will this matter in 5 years? If no, ignore it. Defocus. Step back. The signal is almost always in the background, moving slowly, while the noise is in the foreground, screaming loudly. Let's apply libertarian paternalism to the concept of digital sovereignty. Thaler wants the government to nudge us, but in a decentralized world, code nudges us. The protocols we use determine our freedom. Bitcoin is a nudge towards savings and low time preference because of the hard cap. Fiat is a nudge towards spending and high time preference because of inflation. You are choosing your governing architecture by choosing your money. When you hold fiat, you are subjecting yourself to the nudges of the central bank. Spend, borrow, speculate. When you hold hard money, you are subjecting yourself to the nudges of mathematics. Save, build, verify. This is the ultimate choice architecture. You are opting out of the Keynesian nudge and opting into the Austrian nudge. Choose the set of incentives that aligns with the person you want to become. Finally, in this segment, let's revisit the endowment effect regarding ideas. We overvalue our own ideas just because we thought of them. Not invented here syndrome. In investing, this leads to falling in love with your own thesis. You did the research, you wrote the memo, so you defend the trade even when it goes wrong. The fox treats ideas like disposable tissues. Use them, test them, throw them away. Do not marry your positions. The market pays you for being right, not for being consistent. If you find yourself getting angry when someone attacks your investment on Twitter, you are suffering from the endowment effect. You have merged your ego with the ticker symbol. Detach. The ticker symbol is just a vehicle. If the vehicle breaks down, get out and walk. Don't go down with the ship just because you painted the hull. We have now traversed a landscape of market anomalies, the dark arts of corporate nudging and the gamification of our own psychology. The picture Thaler paints is one of minefield. The modern digital world is not neutral. It is an active combat zone where your attention and your capital are the targets. The econ walks through the minefield blindly, assuming the mines won't explode because explosions are inefficient. The human runs through in a panic, stepping on every mine. The Captura fox walks slowly, using a metal detector behavioral awareness, mapping the hazards and stepping only where the ground is solid. I want you to check your email inbox right now. Search for subscription. Look for the recurring charges you have ignored. Calculate the annual cost. That is the sludge tax. Cancel 3 of them. Use the anger you feel at being nudged to fuel the action. Reclaim your capital. We stand at the precipice of a new era. The era of misbehaving as Richard Thaler studied it. Humans making silly mistakes in a human world is ending. We are entering the era of algorithmic exploitation, where humans make predictable mistakes in a machine-controlled world. The asymmetry is growing. The house, the platforms, the exchanges, the banks, is upgrading its intelligence exponentially. You, the player, are still running on the same biological hardware from 50,000 years ago. This is the singularity of nudge. Soon, your AI assistant will know you better than you know yourself. It will know your blood sugar level, your sleep debt, your emotional state, and your bank balance in real time. This power can be used 2 ways. The predatory path. The AI, owned by a corporation, waits until you are tired, hungry, and lonely to suggest buying a luxury product or gambling on a trade. It maximizes extraction. The protective path. The AI, owned by you, the sovereign, intercepts the predatory offer. It says, "Dave, you are stressed. I am blocking your trading app for 2 hours. Go for a walk." It maximizes well-being. The ultimate battle of the next decade is for control of this intermediary layer. Will you be nudged by an agent that serves shareholders or an agent that serves you? Thaler's philosophy demands that we build and demand fiduciary AI, an AI that is legally and mathematically bound to act in your best interest. Until that technology exists, you must be the manual override. We must also confront the death of privacy as a behavioral crisis. Thaler notes that people behave better when they are watched. This is the Hawthorne effect. In a surveillance state or a transparent blockchain world, we might all behave better, more compliant, more rational, but we lose the right to misbehave. We lose the space for experimentation, for weirdness, for the happy accidents that drive innovation. A perfectly rational, perfectly observed world is a stagnant world. The Captura strategy is to preserve dark zones. Use cache. Use privacy protocols. Keep parts of your life offline, not because you are a criminal, but because you are human. You need the freedom to be irrational in private, so you can be creative in public. We must also adopt epistemic humility as a lifestyle. The hedgehog pundits scream predictions. The econs claim certainty. The fox admits, I don't know. Thaler's career is a monument to saying that's funny, rather than that's wrong. When you see something crazy in the market, like a meme coin worth billions, don't get angry. Don't say that shouldn't happen. Say that is happening. Why? Curiosity is the antidote to judgment. The market is never wrong. Your model of the market is wrong. Update the model. Finally, we return to the title, Misbehaving. To misbehave in the eyes of an econ is to be irrational, but to misbehave in the eyes of a rigid, oppressive system is to be free. The entrepreneur misbehaves by challenging the monopoly. The artist misbehaves by breaking the rules of composition. The sovereign individual misbehaves by opting out of the fiat currency system. Thaler proved that being human is a bug in the economic code. But for you, being human is a feature. Your intuition, your empathy, your creativity, your ability to dream, these are things the algorithm cannot replicate yet. The goal is not to become a robot. The goal is to build a fortress around your humanity so that the robots cannot exploit it. You are now armed. You have the pre-mortem to see the future. You have the commitment device to bind your will. You have the skeptical eye to spot the sludge. You have the mental accounting firewall to protect your capital. You are no longer a passive participant in the behavioral experiment. You are the scientist. You are the observer. You are the anomaly that the system cannot crush. Go forth. Be rational when it matters. Be human when it counts. And never, ever let them nudge you off your path.